Hello, I'm Jeff Selke, the president of Selke Financial Group and JRS Wealth Management. I'm here to give you today an update on the economy and the stock market. We try to do this a couple times a year for our clients. And of course, they can feel free to forward this on to anybody they know and care about. Um, so it's the first quarter of 2023. We're going to talk about what's going on, the good, the bad, and the ugly. And try to show you what's going on in the economy and the markets and why. So let's get started. Monetary tightening is painful. Monetary tightening is when the Federal Reserve decides they're raising interest rates, they're trying to suck money out of the economy. The opposite of monetary easing, which is what they did as the COVID virus hit and the economy was shut down by the federal government. They did monetary easing. They lowered interest rates to zero. They printed trillions of dollars. And when the Fed and really our government, our politicians, decided to print trillions of dollars, and we're talking about $6 to $7 trillion that they printed in the name of COVID. As they did that, that caused inflation. So that is why we have inflation today. It is all that extra money going out in the system, and people are spending it. Companies are spending it, and so that caused goods to go up in value and costs. And wages went up because they needed to pay more wages to attract people who had gone home and got used to not working and getting unemployment checks. And so all of that happened, and now we've got inflation. And in order to fight it, the Federal Reserve is raising interest rates very quickly. And in fact, this is a quote from Jerome Powell, the chairman of the Fed. He said, "We have got to get inflation behind us. I wish there were a painless way to do that. There isn't." So he's telling us that, hey, there's going to have to be pain. In fact, he's used the words demand destruction, meaning he is going to destroy demand in the economy if that's what he has to do to get inflation to come down. So the problem with that is it's starting to work. He has raised interest rates. The Fed has raised interest rates since March of 2022 very quickly. And as that sharp incline in interest rates is happening, that is slowing down the economy. And it is causing inflation to start to go down. So there's some good to it, but there's also some bad to it. And we'll talk about both of those things that are happening right now. So manufacturing orders just hit a 40-year low. This is bad. So we're going to talk about the bad first. That's a bad sign. If companies are not manufacturing as much, that means they don't think they need as many goods. They don't think the demand is there. So that is a negative for the economy. Another thing that's a negative is new and existing home sales are plunging. Mortgage applications are down 45% in the past year. And so we've seen this as interest rates go higher, less people can afford to buy that new house because home prices are still high, but home prices are going down. Real estate is going down. And I said this about a year ago as they started to raise rates. I said, watch, real estate will go down in value. And it has. And it's just starting and it's going to continue probably for the next year or two, I think. Could be wrong on that, but that's what I believe is going to happen with real estate. So if you're looking to buy real estate, I would say hold off for a year or two. There's probably going to be better deals. Um, but we'll see. We'll see what happens. Um, Credit card usage has jumped recently, and that's not good. That's not a good sign. That means more people are living paycheck to paycheck, having to put their bills on their credit card, and so they're running up their credit card bills. That's a bad sign for the economy. Gas prices ended the year down in 2022, but we've already seen at the first part of 2023 that they're up significantly. In fact, we got down to about $3 a gallon. Now we're back up to close to $4 a gallon. That's in Utah. If you're in other states, you're seeing different numbers. In California, you might be paying $5, $6 a gallon at this point, and it's only going to get worse. I believe gas prices are going to go higher going into the summer as we get into the summer months. So be prepared for that. I believe gas prices are going to be higher. So that's it was a positive in 2022 that gas prices came down, but it's a negative in 2023 that they're on their way back up. So those are some things that are happening that are negatives. Here's some positives about inflation. Shipping rates from China to the United States are down 93% from their peak. So shipping rates skyrocketed. The cost to ship goods from China just skyrocketed during COVID and the pandemic and everything. And now those prices have come back to normal levels. That's outstanding. That's going to cause goods to cost less because it's costing less to ship goods from China. Used car prices are down 14% over the past year. That's a great sign because used car prices shot up and went up way too high. It didn't make any sense, but it's just what happened. And so did new car prices. You know, you're not getting a deal on buying a new car. That's changing. That's changing. So watch that as prices come down. That's a good sign for consumers. Lumber has come back to earth. We saw lumber get out of control where it went 4 to 5 times more than it normally would be to buy that 2x4, you know, at Lowe's or Home Depot or wherever you buy them. And so those prices have come back to earth. Thank goodness, because the cost of building a house, construction, anything just was obscene because of the cost of lumber. And so those prices are starting to come down. That's a great sign. Natural gas in Europe has come down tremendously. That's good for Europe. That's good for us because we're paying less for natural gas for heating our homes, things like that. Manufacturing prices, the green line represents the cost basically of manufacturing, and it's come down a lot over the last few months. That's a great sign. We want to see that costs are coming down. That can help inflation start to come down. Food prices should soften very soon. I don't know about you, but for about 3 months, I didn't buy any eggs. I didn't buy any eggs. For $5 a dozen. That's a ripoff. And so my kids went without eggs for months, pretty much, and they didn't seem to notice. It's kind of funny. But now I just went back to the store last week, and they were $2.60 a dozen. That's a great sign that we're seeing food prices start to come back down. They're still not back to where they were, but they're coming down. That is the start of inflation coming down. We want to see that. We want to see prices come down so that it's more affordable for people to buy food and to buy groceries. Inflation is slowing dramatically compared to where it was. So the last half of 2022, inflation went down. It was going up the first half, it went down the second half. That's a great sign. That's when the Federal Reserve started raising interest rates. And again, that's hurting the economy because it's slowing things down, but it is helping get rid of inflation or at least bring it down. Inflation is sticky and it is not going to go away probably for a year or two or three. But if it can keep going down slowly, that's a great sign. That's what we want to see. Um, okay, there's been a lot of negativity. 2023, or sorry, 2022 was the third worst year in the last 40 years for the stock market, for the US stock market. That's bad, right? The third worst year. The S&P 500 was down almost 20%. That's the big companies that represent the US stock market. The Nasdaq was down over 30%. Those are technology stocks. That's scary. That's scary on, bad year. A lot of stocks went down. And I know some people who lost 40, 50, 60% of their money in risky investments in 2022. So 2022 was a really rough year. Cryptocurrency was down 70% on average. I mean, it was a bad year. Bonds had their worst year since the Great Depression and probably their worst year ever. And so that's bad. Bonds lost a lot of money because of the rising interest rates. So last year was a terrible year for investing. Real estate again started to come down and is going to keep coming down. And so, we're in a rough position. So the question is it over? Panic selling in equities hit a record pace at the end of 2022. So historically speaking, that's actually a good sign. As investors get scared and start fleeing and emptying their mutual funds and their 401ks, usually that's a sign that maybe the worst is over and the market is about to bounce up. So that's a good sign. When the market has dropped 20% in 6 months, the following year has been a powerful rally. So what that means, the first 6 months of 2020, the stock market dropped over 20%. It was a really rough first half of the year. And historically speaking, the next year, the stock market gains about 31% on average. Now, whether that's going to happen this time or not, I don't know. And I would say maybe not this time. But that's a good sign that tells us, hey, when the market takes a big drop, usually there's a big increase afterwards. And we may have to wait 6 months to a year or more for that to happen, but it's coming. Economic fundamentals, they're slowing but solid. So things are solid but slowing. Earnings and expectations are solid, meaning earnings is revenue, how much revenue companies are making. So the big companies that make up the stock market are making more money than they've ever made. Last year, the last 2 years, they've made more money than they've ever made before. And this chart is showing they expect to make even more this year in 2023. Whether or not that's going to happen, we're going to have to see because the economy is slowing. People are going to start pulling back. Corporations are going to start pulling back, maybe spending less money. And that will probably cause these companies to not have as high of a revenue as they expect or they're hoping to have. Corporate balance sheets are excellent, meaning companies don't have too much debt. They can afford the debt based on their cash flow. That's a good sign. Small businesses are still flush with cash, as are individuals. There's so much cash, trillions of dollars sitting in bank money market accounts, saving accounts, checking accounts. So that's a lot of money that at some point will be put to work in investments or be spent in the economy. Individual investors have increased their cash levels in their investment portfolios. Again, this is a sign that, hey, maybe we're reaching a bottom here because basically people are scared. And when people get scared, the market bottoms and starts to go back up. So we may be getting close to a bottom based on historical data. Households are still utilizing reduced levels of available credit. What this means is we're not in debt up to our eyeballs as a whole. As a country, our government is in debt up to its eyeballs, but we as individuals, households, are using less of our credit, our available credit, meaning our credit card, limits that we could go to, and our available maybe equity that we have in our homes. We're not using all that equity, and that's a good sign. That's good. Bank balance sheets are exceptional. Now we got to talk about banks. This just happened. Three banks just were taken over by regulators, meaning in essence they didn't go bankrupt, but they were taken over because the fear was that the banks were not in a good financial position and could go into bankruptcy. So the federal regulators came in and took the banks over, and there was a fear that that could create a contagion effect. Could other banks go bankrupt? Could this cause all sorts of problems? Well, the federal government has stepped up and said, we're going to guarantee deposits. Now, whether or not what they're doing is legal or, based on the Constitution, who knows? But they're doing it. And so they're saying, hey, we're going to guarantee depositors. That means anybody who had money in these banks isn't going to lose it. That's a big deal because there would have been billions of dollars lost. So they've guaranteed that money. That should contain any contagion effect to other banks. Not a good sign that these banks would bankrupt. One of them was Silicon Valley Bank out of California, mostly dealt with technology companies and cryptocurrency companies. And those are the companies that are hurting the worst right now in this time period that we're in, that I think we may be going into a shallow recession coming up here in the summer of 2023 or the fall of 2023. So banks as a whole are solid, but there are some banks who obviously are not. Risk assets are not cheap, but they're much more reasonable. This is just price to earnings, meaning valuation of the U.S. stock market, of the S&P 500. And basically what this is showing us is that the value, or really the cost, I guess you could say, has gone down. So they're not cheap, but they're also not expensive anymore now that stocks have come down so much in 2022. So that's a good sign for stocks, that they're not overly expensive, that they're fairly valued based on historical standards. Tech stocks are expensive, but because of last year losing about 30%, they're not as expensive as they once were. And they're nowhere near as expensive as they were back in the technology boom and then when it burst back in 2000 that you can see on this chart. Could cryptocurrency lead to a broader market crash or bank run? Probably not. The current value of all of the cryptocurrency is about 800 and something billion dollars. That's equal to the shares of Johnson & Johnson and United Healthcare. So two very big, important insurance companies. But even if those insurance companies went bankrupt, that would not cause the end of our society and the end of the stock market. And so cryptocurrency is really small compared to the stock market, or the bond market is even larger. So just to put in context, stock prices track earnings over the long run. So over the long run, these two lines, the red and the blue, basically are showing this S&P 500, so the stock market value, with earnings, meaning how much money are the companies making, their revenue. And what you see is the two lines basically stay in line, other than COVID, when the economy was shut down. You can see that red big drop in 20, I think that's what that was. Or no, that was 2008. That big drop was 2008. As you can see, there was a big drop in 2008 in earnings. Companies weren't making money as the economy really was in trouble. But as we bounced back, those revenues went up, and you can see that the economy and the stock market, things, they just tend to stay in line. But what that tells us is if companies are making money, the stock market should go higher over the long run. That's a good sign right now because companies are still profitable and making lots of money. Volatility is the price of admission. If you're going to be in any risky assets, including stocks, real estate, you've got to look at it long term. Bear markets on average last about 1.2 years and drop about 38% on average. So bear markets hurt. They're not fun. But the average bull market, when the market goes up, lasts about 5.7 years. And the average gains are about 200%, meaning you doubled your money a couple times. And so that's amazing. So just be aware that the good times outweigh the bad times with the stock market, but right now we are in a bad time, and that is hard. It is really hard to deal with emotionally. Be careful. There's still plenty of garbage out there. Basically, there's something called zombie companies, and these are companies that can't even afford to pay their debt. They don't have enough cash flow, profits to pay their debt. So they're borrowing basically to pay their debt. That's not a good sign, and that's about 20% of U.S. companies right now, roughly. And so that's a huge number. So that's something we just try to avoid those companies. Stay away from those companies that are not profitable, that have high debt loads. We don't like those, and you don't want those in troubling times and recessions because those are the companies that could go bankrupt. Okay, summary. The economy is quickly slowing. Inflation is slowing. It's going down. That's a good sign. Supply chain inventory issues are improving. Housing is going to cool dramatically. We don't think it's going to crash, but it's going to cool and go down in value. So we don't think the Fed is done hiking. In fact, we think they're going to hike several more times in 2023. But these new bank failures could cause the Fed to at least pause and slow down. They're either going to pause, maybe skip raising interest rates the next time they meet, or maybe they'll just slow it down because the economy is fragile right now. We could go into recession if things keep slowing. So the Fed may slow down, and so that could change things. What do we like? We like a lot of things. As I talked about, inflation is going down, cash is everywhere. We've got a strong labor market. If you want a job, you can pretty much get a job right now. Although many companies, mostly tech companies, are starting to lay off tens of thousands of people. So we're starting to see layoffs. And so we've got to watch that. Valuations are back to normal, I'd say, in the stock market. But we've still got things we worry about. We worry about inflation. We worry about the Fed raising interest rates and going too far and creating a recession. We worry about China and Russia and the geopolitical risks there. So there are definitely things to worry about. What I want to tell you is if we're managing our money, I want you to sleep at night. So make sure you are able to sleep at night. If you're not, give us a call. Give us a call and we'll talk about your situation. Make sure you do feel comfortable. And if that means moving assets around, we'll move them. I always tell you, I always say, you've got to have some safe money assets for times like this. This is why I preach having risk assets, which would be stocks, bonds, real estate, and having some safe assets that might be a fixed annuity or a fixed rate account, something that just guarantees a certain rate. Having those safe money assets allows you to not have to draw from the risky assets in bad times, because the worst thing you can do is take money out when you're down. We want to leave that money alone, let it come back. But you want to take from your safe accounts, your safe money in the bad times. So my goal is to create financial peace for you, for your family. If you have any questions, concerns, please call us right away. Happy to help. Shoot us an email. This is just disclosures. And anyway, I just want you to know, care about your financial situation. I care about you, and I hope you're doing well. Let us know if you need anything, and hope this update was helpful. And we'll talk to you soon. Have a great day.